A revenue multiple you can think of as like a snapshot in time. It's looking at the company where it's at today based on the revenue and what it's selling for. There's a whole bunch of other things that means that's not taking into account. Like, what's their expected growth rate? If that company is going to 10x next year, right, that revenue multiple would be down by a factor of 10. So even though it might look higher here, as a static view, it might actually still be a potentially good investment opportunity if they have the growth, the customers, the traction, everything else to support that. So I think if I'm kind of looking at this chart and just the industries, one of the things that I'm thinking as well is that we're probably seeing companies that have that bigger upside growth potential for some of the reasons Leia was talking about, right? Electrification of the grid and everything else. But in addition, public market energy companies, they're probably a bit bigger, a bit slower, not growing as much, right? And their upside may be more capped. So it could be a bit of that dichotomy between having really big growth potential for early stage growth companies, whereas later stage growth energy companies rather might not have that same upside potential that, for example, a software company might get in the market or a finance.